In 1869, amidst the bustling streets of New York City, a city teeming with opportunity and ambition, a German immigrant named Marcus Goldman laid the foundation for what would become one of the most powerful financial institutions the world has ever known. His journey was one of vision and determination. Goldman, a former trader of dry goods, saw an opportunity in the burgeoning world of finance. He recognized the potential for growth and innovation in this new industry. He established a small firm specializing in discounting commercial paper, essentially providing short-term loans to businesses. This service was crucial for businesses needing quick access to capital. This humble beginning marked the birth of Goldman Sachs, a name that would soon become synonymous with financial expertise and success. Goldman's son-in-law, Samuel Sachs, joined the firm in 1882, solidifying the family's control and lending his name to the growing enterprise. His involvement brought new energy and ideas. The firm, now known as Goldman Sachs, quickly gained a reputation for its financial acumen and astute investments. Their strategic decisions set them apart from competitors. It played a pivotal role in financing the expansion of railroads, a key driver of American economic growth in the late 19th century. This involvement was instrumental in shaping the nation's infrastructure. Goldman Sachs's expertise in underwriting and distributing securities helped fuel the country's industrial revolution. Their contributions were vital in supporting burgeoning industries. As the 20th century dawned, Goldman Sachs continued its ascent, expanding its influence and operations. The firm expanded its operations beyond commercial paper, venturing into the realm of stock trading. This diversification was key to their sustained growth. It became a member of the New York Stock Exchange in 1896, a significant milestone that solidified its place among Wall Street's elite. This membership opened new avenues for business. The firm's reputation for financial prudence and its ability to navigate the often turbulent waters of the market earned it the trust of both businesses and investors. Their reliability became their hallmark. Goldman Sachs's early success was built on a foundation of hard work, sharp instincts, and a deep understanding of the evolving financial landscape. Their foresight was unparalleled. The firm's ability to adapt to changing market conditions, coupled with its unwavering commitment to its clients, set the stage for its future dominance. Their adaptability was a key strength. However, the road ahead would be paved with both triumphs and controversies as Goldman Sachs navigated the complexities of the global financial system. Their journey was far from over, with many challenges and successes yet to come. The early decades of the 20th century witnessed Goldman Sachs's steady rise to prominence on Wall Street, a journey marked by strategic decisions and visionary leadership. The firm's partnership structure, where profits were shared among its top executives, fostered a culture of intense loyalty and ambition, creating a unique environment that encouraged innovation and risk-taking. This, in turn, attracted some of the brightest minds in finance, bolstering Goldman Sachs's reputation as a breeding ground for financial wizards who were eager to make their mark in the industry. One pivotal moment in Goldman Sachs's ascent came in 1930, when it spearheaded the creation of the first retail money market mutual fund, a groundbreaking development in the financial sector. This innovative financial instrument allowed small investors to pool their money and access higher interest rates previously available only to large institutions, thereby leveling the playing field. The move was a stroke of genius, democratizing access to investment opportunities and further solidifying Goldman Sachs's image as a pioneer in the financial world, always at the forefront of financial innovation. However, the firm was not immune to the devastating effects of the Great Depression, a period that tested the resilience of even the most robust financial institutions. The stock market crash of 1929 and the ensuing economic downturn dealt a severe blow to Goldman Sachs, as it did to the entire financial industry, shaking the foundations of the global economy. Yet the firm weathered the storm, albeit not without scars, demonstrating a remarkable ability to adapt and survive in the face of adversity. The experience underscored the inherent volatility of the markets and the importance of risk management, lessons that would shape Goldman Sachs's approach to finance for decades to come, ensuring a more cautious and calculated strategy. Despite the challenges of the Depression, Goldman Sachs emerged from the crisis with its reputation intact, a testament to its strong leadership and unwavering commitment to its core values. The firm's ability to adapt, innovate, and maintain its commitment to its clients during a period of unprecedented economic turmoil solidified its standing as a leader in the financial world, setting the stage for future growth and success. This resilience would serve Goldman Sachs well as it navigated the increasingly complex and interconnected global economy of the latter half of the 20th century, positioning it as a powerhouse in the financial industry. Goldman Sachs's meteoric rise to the pinnacle of global finance has not been without its share of controversies. The firm's journey is marked by both remarkable achievements and significant challenges. The firm's aggressive pursuit of profit and its close ties to governments and powerful individuals have often attracted scrutiny and criticism. These relationships have sometimes led to questions about conflicts of interest and the influence of big finance on public policy. Over the years, Goldman Sachs has been embroiled in numerous scandals, ranging from insider trading to misleading investors. Each incident has added to the firm's complex legacy, making it a frequent target for both regulators and the media. One of the earliest scandals to tarnish Goldman Sachs's reputation involved the collapse of the Penn Central Transportation Company in 1970. This event was a significant moment in the firm's history, setting the stage for future scrutiny. The firm had underwritten a large bond offering for the railroad giant shortly before it declared bankruptcy, leading to accusations that Goldman Sachs had misled investors about the company's true financial health. This incident raised alarms about the transparency and accountability of financial institutions. The scandal resulted in significant financial losses for many and raised serious questions about the ethics of Wall Street. It also prompted calls for greater regulatory oversight to prevent similar occurrences in the future. Another controversy erupted in the 1980s during the leveraged buyout boom. This period was characterized by high-stakes financial maneuvers and intense competition. Goldman Sachs played a key role in financing numerous hostile takeovers, often employing complex financial instruments that critics argued were designed to enrich the firm and its clients at the expense of workers and shareholders of the targeted companies. These actions were seen as prioritizing profit over people. The firm's aggressive tactics earned it a reputation as a ruthless corporate raider, further fueling public distrust of Wall Street. This image has been difficult to shake, despite efforts to improve the firm's public relations. These scandals, along with others that followed, highlighted a recurring theme in Goldman Sachs's history: the tension between its pursuit of profit and its social responsibility. This ongoing struggle has defined much of the firm's public perception. Critics argue that the firm's relentless focus on the bottom line has often come at the expense of ethical considerations, contributing to a culture of greed and excess on Wall Street. This criticism has been a persistent challenge for the firm. Goldman Sachs, for its part, has consistently maintained that it operates within the bounds of the law and that its actions are driven by a desire to generate returns for its investors. The firm emphasizes its commitment to legal and ethical standards, despite the controversies that have marked its history. Section 4. The Defining Crisis: Goldman Sachs and the 2008 Meltdown. The 2008 financial crisis stands as a stark reminder of the interconnected nature of the global economy and the devastating consequences that can arise from excessive risk-taking and a lack of regulatory oversight. At the heart of this crisis was the collapse of the U.S. housing market, triggered by the implosion of the subprime mortgage market. Goldman Sachs, with its vast holdings of mortgage-backed securities, found itself deeply entangled in the unfolding disaster. Leading up to the crisis, Goldman Sachs, along with other major financial institutions, had packaged subprime mortgages, often characterized by high risk and low creditworthiness, into complex financial instruments known as collateralized debt obligations, or CDOs. These CDOs were then sold to investors around the world who were often unaware of the underlying risks. As the housing bubble began to deflate, defaults on subprime mortgages surged, sending shockwaves through the financial system. The CDOs, once considered safe investments, rapidly lost value, leading to massive losses for investors including banks, pension funds, and individuals. The crisis quickly escalated into a global financial panic as banks stopped lending to each other and credit markets froze. Goldman Sachs, despite its sophisticated risk management systems, found itself facing billions of dollars in losses on its mortgage-related investments. The firm, once considered a bastion of financial strength, was forced to seek government assistance to avoid collapse. The image of Goldman Sachs, the epitome of Wall Street success, Pleading for a taxpayer bailout fueled public outrage and further eroded trust in the financial industry. Section 5. The aftermath, public fury, and political fallout. The 2008 financial crisis had a profound impact on Goldman Sachs, both financially and reputationally. The firm, once revered for its financial prowess, became a symbol of Wall Street greed and excess. Public anger towards Goldman Sachs and other financial institutions deemed too big to fail was palpable. In the aftermath of the crisis, Goldman Sachs faced a barrage of lawsuits, investigations, and regulatory scrutiny. The firm was accused of misleading investors about the risks associated with mortgage-backed securities, betting against the same investments it was selling to clients, and profiting from the very crisis it helped create. The political fallout was equally significant. The crisis exposed the cozy relationship between Wall Street and Washington, leading to calls for stricter financial regulations and greater accountability for those responsible for the meltdown. The Dodd-Frank Wall Street Reform and Consumer Protection Act, passed in 2010, was a direct response to the crisis and aimed to prevent similar disasters in the future. Goldman Sachs, despite its efforts to defend its actions, was forced to pay billions of dollars in fines and settlements related to its role in the crisis. The firm also implemented internal reforms and adopted a more conciliatory tone in its public statements. However, the damage to its reputation was undeniable, and the question of whether Goldman Sachs had learned from its mistakes lingered.